Hello class, we are going to be presenting your weekly update on market developments for the week of March 19th. Here's the agenda for today. I'm going to start by talking about recent financings. In the equity markets, there were a few IPOs, 3 of them being on Thursday. ExactTarget, an email marketing company, led the way. It saw its price rise 32% in first day trading. Vantiv, a payment services company, and Caesarstone, a quartz manufacturer based in Israel, were the other 2 IPOs on Thursday. Vantiv outperformed expectations while Caesarstone underperformed. JP Morgan was the lead bookrunner on all 3 of these IPOs. On Friday, there were 2 more IPOs. One of these was VipShop Holdings, an online discount retailer based in China. This was the first U.S. IPO by a Chinese company since August, and was closely watched by many to see how the market treated it. VipShop did not do well on its first day. Its price slipped 15% after pricing below its expected range. The other IPO was Whiting USA Trust, an oil and gas company out of Texas. Whiting outperformed expectations. One of the major stories of the week was Bats Global Markets' canceled IPO. The third largest U.S. equity exchange was set to start trading on its own exchange on Friday. The IPO was all set to go and the stock started trading, but within seconds, a glitch in the system sent the stock price to near zero. Bats stopped the trading and eventually pulled the IPO. Morgan Stanley, the lead bookrunner, and other banks may miss out on millions of dollars in fees. Looking internationally, there were 2 major IPOs in Europe. These were the biggest IPOs in Europe since July. In the debt markets, there was 1 corporate bond issuance. United Surgical raised $440 million through high-yield bonds. There were many municipal issuances, but a big one is set to issue today. The California Public Works Board is going to raise over $900 million in investment-grade bonds. Moving away from financings and looking at new products or services introduced by investment banks, there was one major development with Bank of America's mortgage department. The bank launched a program that would allow homeowners at risk of foreclosure to pass the deed to the bank and rent out the house from the bank at the market rate so that they can stay in their home. This is a major change in how banks deal with borrowers near foreclosure.
On Monday, the Dow Industrial saw a gain of 6.51 points after steady readings from home builders and heavy buying in the tech sector. This is the Dow's 8th climb in 9 sessions. The S&P saw its highest close since May of 2008, while the Nasdaq had its highest finish in more than a decade. Unfortunately, on Wednesday, the Dow fell for a second consecutive day. Part of this decline can be attributed to some of the major energy shares, including Chevron and ExxonMobil. The Dow experienced its 3rd consecutive day in the red, on Thursday falling 78.48 points. This decline followed reports from Europe and China which showed a slowdown of manufacturing. On Tuesday, Apple announced that it would start paying a quarterly dividend of $2.65 a share and begin a share repurchase program, buying back $10 billion worth of shares. This is something that Steve Jobs always resisted. However, Tim Cook says that Apple has more cash on its balance sheet to run its business. On Wednesday, Japanese regulators proposed their first ever fine of a major financial firm for insider trading. The penalty totaled 50,000 yen, or $600 US. On Capitol Hill, after a 6-year effort, Congress is finally proposing legislation that would make it illegal for members of Congress and their aides to use confidential government information to engage in insider trading. Approval should be reached by next week. The SEC is cracking down on rapid trading within computerized stock exchanges. They are examining to determine whether close links to computerized stock exchanges give some trading firms an unfair advantage. Although this is still in its early stages, the objective is to maintain fair markets. On Friday, an email was discovered that links John Corzine of MF Global to $200 million of missing customer funds. With this new development, it is no question why exchange operators came up with the name Corzine Rule for new regulatory rules that restrict what brokerage companies can do with customer money. Under the Corzine Rule, one of a futures firm's principals must approve any money moved out of customer segregated funds if it is more than 25% of the firm's excess segregated funds.
Development in the merger and acquisition market. The most sought-after new M&A news of the week was between Great Wolf Resort and Apollo Global Management LLC. Great Wolf Resort Inc., Wolf, and Apollo Global Management LLC merger. Great Wolf Resort is involved in the indoor water park business. Due to the depreciation of Great Wolf's share prices, management made some strategic moves to enhance shareholder value. Great Wolf's strength has been in the indoor water slide and pool global resort business. Their market share spans across 11 resorts in the U.S. and Canada. Apollo Global Management LLC. Apollo Global has been involved in the private equity, credit-oriented capital market, and real estate for the past 21 years. Apollo Global offered to buy Wolf at $5 per share. According to industry analysts such as Neuberger, Behrman Group LLC, and Wallace Beck Capital LLC indicated that the bid was too low. Despite repeated call by the CEO, Kimberly Schaefer, that the Apollo offer was the best overall after 33 potential buyers expressed interest. Great Wolf's financial trouble started in 2004. Great Wolves lost substantial revenue since 2004 due to its debt repayment plan. Due to loss of revenue for the past 8 years, analysts view the buyout by Apollo as preposterous because the shares are below market value. Analysts and investors suggest that the share price needs to be adjusted up to at least $6.50 a share. Compelling opportunities in these measures are Apollo agreed to buy Great Wolf in a deal valued at $649 million, including its net debt, according to data provided by Bloomberg News. Great Wolf and Apollo will benefit from tax-free reorganization exemptions. On March 20th, Great Wolf CEO Schaefer said in a telephone interview to Bloomberg News that the merger with Apollo was a compelling opportunity for shareholders. The merger will help inject the cash infusion Great Wolf needed to become a global leader in the resort water park industry. And that's how the bidding process worked. A confidentiality agreement was signed on March 13 to consummate the deal. The same day, those 11 companies signed a confidentiality agreement to review the financial statement. Great Wolf filed with the SEC to expedite the deal. Did the poison pill help the deal? Since March 15th, a group of shareholders filed lawsuit in Delaware Chancery Court to bar the deal from happening. The so-called poisoning pill was the only single preventive measure used to make it difficult for any acquirer to outbid Apollo. And now to the conclusion of this measure. This M&A is to help Great Wolf Resort to unlock its prodigious potential. According to Teleprobin, FPLC, and other M&A analysts, Apollo must pay more in the takeover. The argument stems from the fact that the Great Wolf Resort are able to generate revenue all year round because of its indoor resort and water slide businesses.
And now to the economic conditions. The U.S. GDP is expected to grow at a rate of 2.3% in 2012, which is faster than the 2011 rate of 1.7%. Although it's not the optimal growth percentage the U.S. would like to see, but it is always better than a shrinking GDP. Also, consumers are finally spending more as confidence grows among consumers. The employment rate is one of the most highly used rates for measuring the condition of the economy. Unfortunately for the U.S., employment rates are not as good as they could be. Projections of the 2012 unemployment rates do not see a significant decrease in the number of people unemployed. In fact, the rates will be about the same as 2011, which was 8.3%. The Fed has recently announced that it would keep interest rates hovering around 2% up until 2014. This action by the Fed is a clear indicator of the Fed's presumption of the recovery process for the United States economy. The Fed is keeping interest rates low as an incentive for businesses and individuals to spend through the means of loans. Business spending will not have the same progress as it did in 2011. Business spending increased by 8% in 2011 compared to a projected 6% for 2012. With the U.S. facing a slow to moderate growth levels, inflation will be low for 2012. The Fed is targeting a 2% rate for inflation compared to 3% during 2011. The inflation rate is a non-issue due to the slow growth of the overall economy. And now to investment banking news. Andre Orcel was Bank of America's chairman of global banking and markets, and losing Orcel is a blow for Bank of America, which is under pressure for its flagging performance. Orcel will help to run the investment banking division that was rocked by key departures and last year's $2.3 billion loss from unauthorized trading. Also in the news, Goldman Sachs has begun a new round of staff cuts in its trading and investment banking division, which is a continued sign of Wall Street's penny pinching.
Global market updates. Asian markets finished lower this week, with shares in Japan leading the region. Slowdown of manufacturing in China draws concerns. China's demand for iron ore, which is used to make steel, is widely watched this week. The Nikkei is down 1.14%, while the Hong Kong's Hang Seng is down 1.11%, and China's Shanghai Composite is 1.10%. Moving to the UK's FTSE, it's up 0.16%. Germany's DAX is up 0.21%, and France is up 0.11%. Brazil's Bovespa is down 0.02%, and the Mexican Bolsa is up 0.03%. Europe debt crisis, cost of mortgages. Banks in some of Europe's most troubled economies have been steadily raising rates on mortgages, making it more expensive for citizens to keep up with their payments and for them to buy new homes. Move to Germany, which is Europe's largest economy contributor to almost half of the Eurozone's 440 billion bailout fund. And move to Greece. The vast majority of Greece's private sector creditors, they have agreed to do a bond swap to restructure 200 billion euros. The dollar stumbled against the euro and the yen after the U.S. housing report signals down on the economic recovery. New home sales have fell for the second consecutive month. The greenback tumbled against the yen to 82.35, and the euro was at $1.3270. Also, the euro got a boost from encouraging news in France, and the government raises forecasts for future growth. The British pound bought $1.5869. Commodities. Oil futures rose $1.52 following a report that Iran had reduced its oil exports. U.S. and allies increasingly apply sanctions on Iran to stop nuclear work. And also the gold per troy ounce was up 1.22%. Corn was also up 0.31%.